Welcome to the Deep Dive, where we demystify complex financial topics and uncover the powerful insights that can truly impact your bottom line. Imagine this scenario. It's nearing year end, and you're reviewing your financial position. Maybe you're a real estate investor who just made a savvy sale, or perhaps a federal executive navigating new ethics guidelines. Suddenly, you're faced with a significant capital gain, and the thought of a hefty tax bill starts looming large. This isn't just about paying taxes, it's about seeing a substantial chunk of your hard-earned capital diverted before it can keep working for you.
It feels like a punch to the gut sometimes.
Right. But what if there are specific, powerful provisions in the tax code that could allow you to defer that entire gain, effectively keeping your capital invested and growing, rather than immediately handing it over to Uncle Sam?
That's exactly the strategic advantage we're diving into today. The gut reaction is often, well, got to pay the tax. But with careful planning and really understanding certain IRS mechanisms, the outcome can be fundamentally different. It's all about proactive financial management, especially when you're looking at big asset sales near year end, spotting those chances to minimize your current tax liability.
Exactly. Our mission in this deep dive is to explore two highly specific yet incredibly impactful U.S. tax provisions. One deals with property sales, and the other, fascinatingly, with conflict of interest sales. We're going to unpack IRS Form 8824, titled Like-Kind Exchanges and Section 143 Conflict of Interest Sales, plus its instructions. Our goal isn't just to explain the form line by line, though we'll do some of that. It's to show how people like you can potentially minimize your current year tax hit by deferring gains, keeping that capital working, instead of it being immediately siphoned off by taxes.
Absolutely. And just to be clear, everything we're discussing today comes straight from the horse's mouth, so to speak.
Yeah.
We're using the most current IRS Form 8824 for 2024 in its official instructions. So this isn't guesswork. It's practical guidance directly from the IRS.
So what can you, our listener, expect? We're aiming for clear explanations, practical, real-world examples, and hopefully those aha moments where you see how these seemingly complex tax forms are actually really valuable tools for strategic financial planning. They're about empowering you to manage your tax liability proactively, especially as you approach year-end. Let's jump in.
All right, our journey starts with a real cornerstone of strategic real estate investing, the like-kind exchange. This is a pretty powerful concept, rooted deep in the tax code, letting you defer capital gains when you swap one investment property for another. So let's start basic. What exactly is a like-kind exchange? Well, at its heart, it's a tax deferral tool.
Yeah.
Section 1A31 of the Internal Revenue Code. The basic idea is pretty straightforward. If you exchange business or investment, real property, and that's key, real property, solely for other business or investment real property of a like kind, then generally no gain or loss is recognized for tax purposes at the time of the exchange, meaning you don't pay tax on that gain right now. It's a powerful way to keep your investment capital working without that immediate tax drag.
That's the real magic, isn't it? It's not that the gain disappears entirely.
No, unfortunately not. It's deferred.
Right, rolled over, essentially. The gain you don't recognize reduces your tax basis in the new property you get, so your capital stays fully invested, keeps generating returns without that immediate tax hit. For real estate folks, this is huge for building wealth over time.
Oh, it absolutely is. But here's a really critical point, especially for anyone thinking about this now. There was a major change with the 2017 tax reform. For exchanges happening in 2018 and later, this beneficial treatment applies only to exchanges of real property. It's gone for personal property. So you can't swap, say, machinery for machinery or collectibles for collectibles and get this deferral anymore. And also really important, the real property has to be held for business or investment, not property you hold primarily for sale like a dealer flipping houses.
Yeah.
It has to be for productive use in a trade or business or held for investment.
Okay, so like-kind property, that term sounds specific. Doesn't mean I have to trade my small office building for another almost identical small office building, or is there more flexibility?
Much more flexible, actually. The IRS looks at the nature or character of the property, not really its grade or quality. For instance, improved real property, like a building with tenants, is considered like-kind to unimproved real property, like raw land, because the underlying nature is real property held for business or investment. The specifics of development don't matter as much as that core classification. You could potentially swap an apartment building for a warehouse or maybe a farm for a vacant lot, as long as both meet that held for business or investment test.
That definitely opens up more possibilities, but I seem to remember a pretty significant geographical limit. You can't just swap a property here in the U.S. for one overseas, correct?
That's a sharp point and absolutely critical. Real property in the United States and real property outside the United States are not considered like-kind properties, period. So you could swap, say, that Florida condo for a Texas ranch, no problem. But you couldn't swap that Florida condo for a beachfront place in Costa Rica and get the deferral. Location matters in that specific U.S. versus non-U.S. context. It's a hard boundary.
Understood. Okay, so given that, the definition of real property itself becomes absolutely central. It's not just, what feels like a building or land. The Form 8824 instructions really dig into what qualifies. Can you walk us through that? This seems like where the details really matter.
Absolutely. This is where it gets interesting and sometimes counterintuitive. For tangible property, there are basically three ways it can qualify as real property for Section 131. First, the most obvious one. If it's classified as real property under state or local law where it's located, that's your typical land and building scenario. Second, and this is quite specific, the IRS regulations actually list certain types of stock as real property. Now hold on, this isn't a free pass for all stock. It's very narrow. Think stock in a cooperative housing corporation, or shares in certain mutual dish, reservoir, or irrigation companies, but only if state law or a high court ruling in that state recognizes those shares as representing real property. Very niche cases. Third, and this is the facts and circumstances test, property can be real property based on how permanently it's attached or integrated. If tangible property is permanently affixed and expected to stay that way indefinitely, it's generally seen as an inherently permanent structure, and thus real property. This also includes structural components, think machinery or equipment, that are really integral parts of that permanent structure, like HVAC systems, elevators, certain custom-built manufacturing equipment bolted into the foundation.
Ah, okay. So it's not just the shell of the building, but potentially key systems inside if they're permanently attached and essential to its function. That makes a difference. What about intangible stuff, like rights or interests related to property?
Yes, intangibles can qualify too, following similar logic. They can be classified as real property under state or local law. They might be specifically listed in the regs. Or, commonly, if they derive their value directly from real property and are inseparable from it. Think of an easement, the right to use someone else's land for a power line, for example, or an option to acquire real property. These are rights, not physical things, but because they're intrinsically tied to the real estate, they can count as real property for the exchange.
Makes sense. Given all that can be included, what's definitely out? What is never considered real property for 1031, no matter what a state might say? Knowing the exclusions seems just as vital.
Crucial for avoiding mistakes, absolutely. The IRS is crystal clear on these exclusions. Regardless of state law, the following are never real property for like-kind exchanges. Stocks, except those very narrow co-op water company exceptions, bonds, notes, other securities, or any evidence of debt. Interests in a partnership are generally excluded too, unless the partnership made a very specific uncommon election under Section 761A. Don't count on that usually. Also excluded are certificates of trust, beneficial interests, and something called choses in action.
Choses in action. That sounds like legal jargon. What does that actually mean?
Yeah, it's a legal term. Basically, it's a right to sue someone or recover a debt. Think of it as an intangible right to property that you can only get by taking legal action, like the right to collect money under a contract or a claim for damages from an injury. It's a legal right, not a tangible asset tied to land, so it's explicitly excluded from being real property here. Knowing these hard stops helps you stay within the lines.
Okay, so we've got the what and why of like-kind exchanges and what counts as the right kind of property. But, like you said, in the real world, finding two people who want to swap properties at the exact same moment is, well, pretty rare. That brings us to deferred exchanges, which seems to be how most of these actually happen. How do those work?
You're spot on. Simultaneous swaps are the exception, not the rule. A deferred exchange is the most common structure. It happens when the replacement property, the one you're getting, is acquired after you've already transferred the relinquished property, the one you're giving up. The IRS set up specific rules for these delayed deals because they knew finding a perfect simultaneous match is tough in the real estate market. It allows the deferral even if the timing isn't perfectly synchronized.
So it's kind of like a relay race for properties, but I understand it's a relay race with incredibly strict deadlines. Is that right?
Excellent analogy. And yes, the deadlines are absolutely critical, ironclad. Missing them, even by one day, blows up the whole exchange. Your deferred gain becomes immediately taxable. There are two main timing hurdles. First, the 45-day identification rule. This pops up on line 5 of the form. You must identify the potential replacement property or properties in writing within 45 calendar days after you transfer your old property. This isn't a casual conversation. It needs to be a signed written document. It has to clearly describe the property legal description, street address, maybe a specific building name, and it needs to be delivered properly faxed, hand-delivered, mailed to the right person, usually your intermediary, within that 45-day window. Now, if you actually manage to receive the replacement property before the 45 days are up, you automatically meet this rule. That can happen sometimes.
45 days isn't a lot of time, especially for identifying specific real estate. And then there's another longer deadline after that.
Correct. That's the 180-day receipt rule, Title Line 6 on Form 8824. You must actually receive the replacement property by the earlier of two dates, either the 180th day after you transferred your relinquished property or the due date, including extensions of your tax return for the year you made that initial transfer. The second part catches people out. If you do an exchange late in the year, say November, 180 days might take you into May of next year, but your unextended tax return is due April 15th. So April 15th becomes your deadline unless you file an extension. The takeaway is stark. Miss either the 45-day identification or the 180-day receipt deadline, and the whole deal is off. It's treated as a taxable sale from day one.
Wow. Okay. Given those tight rules, and especially the need to avoid constructive receipt of the cash from selling your old property, because if you touch the money, the deferral is gone, right? So how do people manage this practically without messing it up? This sounds like you need a specialist.
You absolutely do. And that specialist is the qualified intermediary, or QI. Using a QI isn't just a good idea, it's a specific safe harbor under IRS regulations. It means that even though you're not directly swapping deeds with the other party, the IRS will treat it as a valid like-kind exchange if you follow the QI rules. The QI acts as an independent, neutral third party to facilitate the whole thing.
So what does the QI actually do? How do they keep the transaction tax deferred?
Essentially, the QI steps into the middle of the transaction. When you sell your old property, the relinquished one, the sales proceeds go directly to the QI, not to you. The QI holds those funds in a secure, often segregated account. This is the critical step that prevents you from having actual or constructive receipt of the cash. If those funds hit your bank account, even briefly, boom, taxable gain. Then, when you've identified your replacement property within the 45 days, the QI uses those held funds to buy that property on your behalf and transfers the title to you before the 180-day deadline. They are the legal bridge ensuring the funds flow correctly without you touching them, preserving the tax deferral.
That makes total sense, that they insulate you from the cash. Are there rules about who can be a QI? Can my brother-in-law, the real estate agent, do it?
Good question. And the answer is a firm no.
Right.
The regulations are very strict here. Related parties and your agents, like your attorney, accountant, real estate agent, or investment banker involved in the deal, are generally considered disqualified persons. They cannot act as your QI. It's designed to maintain independence and prevent conflicts of interest or manipulation. Now, it's rare, but QIs can sometimes default, like in a bankruptcy. If that happens, there's an IRS procedure, Reverend Proc 2010-14, that might let you report the gain over time as you eventually recover funds. It's not perfect deferral, but it's some relief in a bad situation.
Okay, good to know there's at least a potential fallback, however rare. What about small amounts of personal property mixed in? Like you exchange a furnished rental condo, do the included appliances or furniture mess up the exchange for the condo itself?
That's where a practical rule called the incidental personal property rule helps. The IRS gets at sometimes minor personal property tags along with the real estate. For the QI rules, this minor stuff is basically disregarded if it meets two tests. First, it has to be the kind of personal property typically transferred together with the real property in similar commercial deals. Think standard appliances in a rental, maybe basic lobby furniture in an office building, not, a valuable art collection hanging on the walls. Second, the total fair market value, FMV, of all that incidental personal property can't be more than 15% of the total FMV of the replacement real property you receive. It's a de minimis rule, basically saying small amounts of typical personal property won't torpedo the real estate exchange.
That seems like a reasonable approach. Okay, let's shift gears slightly and talk about family, or at least related parties. The tax code often has special rules when deals happen between related folks or entities. Like-kind exchanges are no exception. Who counts as a related party here?
Yeah, the definition is pretty broad, designed to capture close connections. It includes your spouse, kids, grandkids, parents, grandparents, brothers, and sisters. But it also extends to entities, related corporations, like if you own more than 50%, S corporations, partnerships, trusts, estates, and even certain tax-exempt organizations you might control. It covers a wide net.
And it's not just direct swaps between, say, me and my sister, right? What if we try to use a QI to make it look indirect?
The IRS is wise to that. The rules explicitly cover indirect exchanges with related parties, too. That includes using a QI or an ET, we'll touch on those maybe later, or even using a disregarded entity like a single-member LLC if it's owned by you or a related party. If the whole structure looks like it was set up primarily to get around the related party rules, for example, you give property to a QI, your related party sells property to the QI for cash, and you get that property as replacement. And the IRS can disallow the like-kind treatment. Revenue Ruling 2002-83 specifically addresses this kind of abusive transaction. Substance over form matters here.
Okay, so they look through the structure to the economic reality, and there's a really big restriction involving a 2-year holding period for these related party exchanges, right? This sounds like it could undo the whole deferral.
It absolutely can, and it's probably the most important rule to grasp for related party deals. Here's the rule. If you exchange property with a related party, and either you or the related party disposes of the property they received in the exchange, before the date that is 2 full years after the last transfer that was part of the exchange, then the gain or loss you deferred on the original exchange has to be reported on your tax return in the year that second disposition happens.
Wow, so even if you deferred the gain initially, if either of you sells within 2 years, that deferred gain comes roaring back and becomes taxable right then. What's the reason for such a strict rule?
It's purely an anti-abuse measure. It stops related parties from using the exchange rules to effectively cash out of a property without paying tax. Imagine you own property A with a low basis, high value. Your sister owns property B. You swap. Now you have B, she has A. If she immediately sells property A, which has your old low basis stepped up to its value in the exchange in her hands, to an outsider for cash, without this rule, the family unit has effectively cashed out your low basis property tax-free. The 2-year rule forces both parties to hold on to the exchange properties for a significant period, demonstrating a continued investment intent, not just a quick basis swap and cash out. There are some nuances where the 2-year clock can be paused or tolled if your risk of loss is substantially diminished, like through options, but that's getting pretty technical.
That's a major string attached. But I know there are some important exceptions to this 2-year rule, found on line 11 of the form, usually. What situations let you off the hook?
Correct. There are 3 key exceptions where you don't have to recognize that deferred gain, even if someone sells within the 2 years. They cover situations generally not seen as tax avoidance. First, line 11A. If the disposition happens after the death of either you or the related party, death basically cleans the slate for this rule. Second, line 11B. If the disposition is due to an involuntary conversion, think government condemnation, major fire, hurricane damage provided the threat of that conversion arose after the original like-kind exchange. It recognizes that some sales are forced and not planned for tax reasons. And third, line 11C, this is the more subjective one. If you can prove to the IRS's satisfaction that neither the original exchange nor the later disposition had tax avoidance as one of its principal purposes, if you check this box, you absolutely must attach a detailed explanation to your return saying why you qualify.
That no tax avoidance purpose sounds like it could be a gray area. Does the IRS give any examples of what might fit under that exception?
They do, thankfully, and the examples give a good sense of the intent. Generally, tax avoidance is not considered a principal purpose if, 1, the disposition itself is another non-recognition transaction. So, if your related party takes the property they got from you and immediately does another valid like-kind exchange with it, that usually passes muster. The deferral continues. 2, if the exchange didn't really give the related parties any significant tax advantage from shifting bases around, maybe both properties had similar basis to value ratios, or the tax attributes weren't meaningfully changed to save taxes. And 3, if it involves an exchange of undivided interests in different properties that results in each party ending up with full ownership of one property, or at least a larger share, like if you and your sibling co-own 2 rental houses 50-50, and you exchange interests so you own 100% of house 1 and they own 100% of house 2, that's usually seen as a legitimate business restructuring, not primarily tax motivated.
That really helps clarify. Okay, so we've navigated related parties. Now let's get down to the numbers. Form 8824, Part 3. This is where the calculations happen, where the rubber meets the road, right?
Absolutely. Part 3 is the engine room of the form. This is where you figure out 3 key things. Your realized gain or loss, that's the total economic profit or loss on the deal before taxes. How much of that gain is recognized, meaning taxable this year, often because you receive something called boot. And, crucially, the basis of the new like-kind property you received. That new basis number is vital for future depreciation and calculating gain when you eventually sell the new property.
You mentioned boot. That word comes up all the time in these exchanges, and it sounds like it's the trigger for current tax. What exactly is boot?
Boot is basically anything you receive in the exchange that is not like-kind property. The most obvious example is cash, but can also be other non-like-kind property, like if they throw in a car or some equipment that doesn't qualify as real property. And very commonly, it includes net relief from liabilities. If the mortgage on the property you gave up was higher than the mortgage on the property you received, or if you received property with no mortgage, that net debt relief is treated as boot received by you.
And what happens, tax-wise, if you receive boot?
This is the critical rule. If you receive boot, any gain you realized on the exchange is recognized, meaning tax now, but only up to the amount of the boot received. So if your total economic gain was, say, $100,000, but you only received $20,000 in cash boot, you only recognize and pay tax on $20,000 of gain this year. The other $80,000 is still deferred. However, and this is key, if you have a lock on the exchange, receiving boot does not allow you to recognize that loss. Losses are generally deferred in a like-kind exchange, even if boot is received. Gain recognized up to boot, loss never recognized if boot received.
That's a really important distinction for planning. Okay, let's make this tangible. The IRS instructions use a great example with Taylor and Finley. Walking through that should really clarify these calculations. Can you set up the scenario and take us through Taylor's side first?
Sure thing. This example really brings part 3 to life. Here's a setup. We have Taylor, own an apartment building. Fair market value, FMV, is $220,000. Taylor's adjusted basis is $100,000. There's an $80,000 mortgage on it. Then there's Finley, owns another apartment building. FMV, $250,000. Adjusted basis, $175,000. This one has a bigger mortgage, $150,000. Here's the deal. Taylor gives their building to Finley. Finley gives their building to Taylor. But the values aren't equal, so Finley also pays Taylor $40,000 in cash. Also, Taylor assumes Finley's $150,000 mortgage on the building received, and Finley assumes Taylor's $80,000 mortgage on the building they received. Now, let's fill out Taylor's form 8824. Taylor's the one getting cash boot. Line 15, boot received. This is cash, FMV of other property, plus net liabilities assumed by the other party. For Taylor, we enter only the $40,000 cash received here. Now, why is the $80,000 mortgage Finley took over counted here? Because Taylor also took on Finley's $150,000 mortgage. Yeah. Taylor assumed more debt, $150K, than they were relieved of, $80K. So there's no net liability relief for Taylor to count as boot on line 15. Only the cash counts here.
Okay, that netting of liabilities is key for line 15. Got it.
Line 16, FMV of like-kind property received. Taylor enters $250,000. That's the value of Finley's building that Taylor got. Line 17, total received. Just add line 15 on line 16. $40,000 cash plus $250,000. Building FMV equal $290,000. Total value Taylor received. Line 18, basis of property given up plus net amounts paid. Taylor starts with their old basis, $100,000. Now we add any net amount paid. Here, Taylor assumed $150K debt and was relieved of $80K debt. The difference, $150K, $80K, is the net increase in debt for Taylor. This $70K counts as a net amount paid. So line 18 is $100,000 basis plus $70,000 net debt assumed, $170,000. Line 19, realized gain or loss. Subtract line 18 from line 17, $290,000 received, $170,000 basis plus net paid, $120,000 gain. This is Taylor's total economic gain. Line 20, recognized gain. Enter the smaller of line 15, boot received, or line 19, realized gain. Line 15 was $40,000 cash boot. Line 19 was $120,000 realized gain. The smaller is $40,000. So Taylor recognizes and pays tax on $40,000 of gain this year. The rest is deferred. Perfect illustration of the boot rule.
That's a crystal clear walkthrough for Taylor. It shows exactly how receiving cash triggers recognize gain. Now let's flip it. How does Finley's Form 8824 look? Finley paid cash and had that complex mortgage relief situation. How does the boot calculation work there?
Great question. Finley's side highlights how cash paid interacts with liability relief, which is often confusing. Quick recap for Finley. Gave up building, FMV $250K, basis only $155K, mortgage $150K. Received building, FMV $220K, mortgage $80K. Paid $40K cash. Taylor assumed Finley's $150K mortgage. Finley assumed Taylor's $80 mortgage. Line 15, boot received. This needs careful calculation. First, Finley was relieved of their $150,000 mortgage by Taylor. That's potential boot, but Finley assumed Taylor's $80,000 mortgage, so subtract that. $150K, $80K, $80,000 net liability relief so far, and Finley paid $40,000 cash. Cash paid reduces boot received. So the net boot calculation is $150,000 liability relief, $80,000 liability assumed, $40,000 cash paid. That equals $30,000. This $30K is Finley's net boot received for line 15.
Okay, so the cash Finley paid directly offsets some of the liability relief they got. Makes sense.
Exactly. Line 16, FMV of like-kind property received. Finley enters $220,000 of value of Taylor's building. Line 17, total received. Add lines 15 and 16, $30,000 net boot plus $220,000 building. FMV equals $250,000. Line 18, basis of property given up plus net amounts paid. Finley enters only the original basis of $175,000 here. Why no addition? Because the total Finley paid out, $80K liability assumed plus $30K cash paid equals $120K, does not exceed the liability relief Finley received, $150K. Since Finley had net boot received on line 15, there's no net amount paid to add here. Line 19, realized gain or loss. Subtract line 18 from line 17, $250,000 received, $175,000 of gain. Finley's total economic gain, line 20, recognized gain, smaller of line 15 boot, or line 19 realized gain. Line 15 was $30,000, line 19 was $75,000, smaller is $30,000. So Finley recognizes and pays tax on $30,000 of gain this year. The remaining $45,000 is deferred.
That Finley example really shows the complexity of netting liabilities in cash. It's not just adding and subtracting, it's about the net effect. Getting that right is crucial for the tax outcome. Okay, beyond just recognizing gain, what about depreciation recapture? Especially with business property, that can bite you by turning lower tax capital gain into higher taxed ordinary income. How do lines 21 to 23 handle that?
You nailed it. Recapture is a big deal. It can significantly change the character and therefore the tax rate of your recognized gain. If the property you gave up included depreciated assets classified under Section 1245 or Section 1250, common for buildings and certain components, part of your realized gain might get reclassified as ordinary income. Let's revisit Taylor. Assuming the building given up included some Section 1245 property, maybe specific fixtures or equipment treated as real property, with $35,000 of prior depreciation taken, meaning its basis was reduced by $35K. Line 21. Ordinary income under recapture rules. Taylor would typically enter the lesser of the total depreciation taken, $35,000, or the total recognized gain, $40,000 from line 20. So here, Taylor enters $35,000. This $35K is treated as ordinary income, reported elsewhere, Form 4797, usually, not capital gain. Line 22. Subtract line 21 from line 20. Taylor's recognized gain, line 20, was $40,000. Subtract the ordinary income recapture in line 21 of $35,000. $45,000, $5,000. This remaining $5,000 is typically treated as capital gain, reported on Schedule D or Form 4797. Line 23. Total recognized gain. Add lines 21 and 22. $35,000 ordinary income plus $5,000 capital gain equals $40,000. This matches the total recognized gain from line 20, but now it's properly split between ordinary income and capital gain, which affects the actual tax calculation. If the recapture had been, say, $50,000, if more depreciation was taken, then all $40,000 of recognized gain might have been ordinary income.
That makes a huge difference in the tax bill, potentially. Okay, so after figuring out realized gain, recognized gain, and recapture, what about the bottom line? The deferred gain and, crucially, the basis of the new property you now own. That's what carries forward, right?
Exactly. These final lines tie it all together and set you up for the future. Line 24, deferred gain or loss. Subtract line 23, total recognized gain from line 19, realized gain. For Taylor, using the $35K recapture example, $120,000 realized gain, $40,000. Total recognized gain equals $80,000. This $80,000 is the gain that gets deferred, rolled over. It's a tax benefit realized this year. Line 25, basis of like-kind property received. This is your starting point for the new property. The formula is line 18, basis given up plus net paid, plus line 23, recognized gain, line 15, boot received. Let's use Finley this time. Line 18 was $175,000, line 23 was $30,000, line 15 was $30,000. So Finley's new basis is $175,000 plus $30,000, $30,000 to $175,000. Now, if the property received has different types of like-kind assets, like Section 1245 and 1250 property, you have to allocate this total basis, line 25, between them based on their relative fair market values. So if Finley's new 220K property had 55K FMV of 1245 assets and 165K FMV of 1250 assets, the 175K basis would be split proportionally. 55K, 220K, 175K kills $43,750 basis for 1245 property, 165K, 220K, 175K, 175K kills $131,250 property. This allocation on lines 25A, B, C is vital for future depreciation calculations.
That basis calculation is definitely fundamental for ongoing taxes. Okay, we really dug into the core of like-kind exchanges. But Form A824 also covers some special situations. One interesting one is combining a like-kind exchange with the home sale exclusion section 121. How does that work if, say, part of your main home was used for business?
Ah, yes, this is a great example of stacking tax benefits, which can be really valuable. If the property you're exchanging was your principal residence for at least 2 of the last 5 years, you might be able to exclude some or all of the gain attributable to the home portion using the Section 121 exclusion, up to 250K single, 500K all married, filing jointly. The 8824 instructions explain how to adjust the calculation. You essentially reduce your realized gain, line 19, by the exclusion amount first. Then, that lower gain figure feeds into the recognized gain calculation, line 20, potentially reducing taxable boot. Finally, the excluded gain gets added back when calculating the basis of the new property, line 25, to ensure proper accounting. Now, if it was a mixed-use property like you lived upstairs and rented downstairs, it gets a bit more complex. The IRS suggests using two forms 8824 as worksheets, one for the home part, one for the business rental part. You run the calculations, lines 1525, on both. Apply the Section 121 exclusion rules to the home worksheet. Then you combine the result onto the single Form 8824 you actually file. It takes careful allocation, but it'll let you potentially get both benefits.
That's a powerful combo. Another advanced topic mentioned is qualified exchange accommodation arrangements, or QEAAs. What are those? What do they let you do differently?
QEAAs facilitate something called a reverse exchange. We've been talking about deferred exchanges. Sell first, then buy. But what if you find the perfect replacement property before you've sold your old one? Maybe it's a hot market, you need to lock it down. A reverse exchange lets you acquire the new property first and then sell your old one later, usually within 180 days. This is done using an exchange accommodation title holder, or AIT, under a QEA structure. The AIT essentially parks the title to either the new property, buys it and holds it for you, or your old property, takes title and works to sell it, while the other side of the transaction gets completed.
So it reverses the timing sequence, giving you flexibility when the ideal property pops up first.
Exactly. It's a crucial tool for navigating market realities. Without it, buying the replacement property first would generally be a taxable event. The IRS laid out safe harbor rules for these in Revenue Procedures 2037 and 2004-51.
Got it. Now let's shift completely to Part 4 of Form 8824. Section 1 of 43, Conflict of Interest Sales. This isn't for typical investors, is it? Who uses this and why?
You're right. This is very specialized. It applies mainly to certain federal executive branch officials, judicial officers like federal judges, and sometimes their spouses or dependent children. The purpose is to provide tax relief when these individuals are forced to sell assets to comply with government ethics laws and prevent conflicts of interest. If the Office of Government Ethics, OGE, or the Judicial Conference issues a formal certificate of divestiture, basically ordering them to sell specific property, Section 243 allows them to defer the capital gain realized on that forced sale.
So it stops them from being hit with a big tax bill just for following ethics rules on a sale they didn't choose to make.
Precisely. It prevents the ethics rules from imposing an unfair financial penalty. But the conditions are quite strict. Gain is deferred only to the extent the sale proceeds are reinvested in permitted replacement property within 60 days of the sale. And permitted replacement property is very limited. Basically, U.S. Treasury obligations or certain diversified investment funds approved by the OGE. You can't just buy any stock or property. It has to be something deemed conflict-free.
Very narrow reinvestment options. And how does the basis work? Similar deferral mechanism.
Yes, it's the same principle. The basis of the permitted replacement property, the Treasuries or approved fund, is reduced by the amount of gain deferred from the original sale. So the gain isn't forgiven, just postponed until that replacement property is eventually sold.
Okay, and there's a specific, potentially very valuable benefit mentioned for statutory stock options under Section 1043. What's that about?
This is a really significant kicker for officials who might be forced to sell company stock they got through options. If the divested property was stock acquired by exercising a statutory option, like an ISO or ESPP stock, Section 1043 rules can allow the taxpayer to be treated as having met the required holding periods for that stock, even if they actually held it for less time before the forced sale. Normally, selling ISO or ESPP stock too early means the gain gets treated as ordinary income, often at much higher rates. By deeming the holding period met due to the forced divestiture, this rule can allow the gain to qualify for lower long-term capital gains rates. For high-level execs with significant stock options, this can literally save enormous amounts in taxes, turning potential ordinary income into capital gain purely because the sale was mandated. It's a huge relief provision.
That is a truly powerful benefit for that specific group. Okay, one last related point. The instructions briefly mentioned qualified opportunity funds, or QOFs. How do they fit into this picture of tax deferral?
Right, QOFs aren't directly handled on Form 8024, but they're mentioned as another related strategy for managing capital gains, especially relevant for year-end planning. Investing eligible capital gains into a QOF within 180 days allows for a temporary deferral of tax on those gains. The really big potential benefit with QOFs, though, is that if you hold a QOF investment for at least 10 years, any appreciation on the QOF investment itself can potentially be permanently excluded from capital gains tax. It requires different forms, Form 8949, Form 8997, but it fits the broader theme. Understanding these specialized tax rules can unlock major opportunities for deferral and potential exclusion.
Absolutely. Well, that brings us to the end of this deep dive into Form 8824. It's been quite a tour, from the intricacies of real estate swaps to the specific rules for government officials facing divestiture. We've really seen how understanding these provisions can dramatically impact your tax situation, especially when planning around significant asset sales or year-end strategies.
It really underscores that these aren't just dusty corners of the tax code. Like-kind exchanges for investors, Section 2043 for officials, these are active strategic tools. When you use them correctly, you can defer substantial gains, keep your capital working harder for longer, and gain immediate tax relief. That's a powerful combination.
It really is. And hopefully those aha moments came through, realizing that nailing the definitions, hitting the deadlines, understanding related party rules, and mastering those Part 3 calculations, it all gives you control. It equips you to handle complex scenarios and gives you, frankly, a strategic edge in managing your wealth. It's proactive, not just reactive.
Well said. It's about using the rules to your advantage.
So, as we wrap up, let's leave our listeners with a thought. We've explored gain deferral for real estate and mandated sales today. It makes you wonder. Considering these specific strategies, what other common life events or perhaps different asset classes might have their own, often overlooked tax advantage strategies just waiting to be uncovered? Strategies that could significantly shift your financial path.
That's a great question to ponder. The tax code is vast, and opportunities often hide in plain sight.
Indeed. Thank you for joining us on the deep dive. We hope this exploration empowers your financial planning moving forward.